Welcome to BAM It with John Michael and Mari, covering all things business, accounting, marketing, management, and IT. The place where businesses and entrepreneurs find the forest through the trees.
Hello and welcome to BAM It. This is Mari Peterson with Marketing Outpost, and today I have with me, as always, John Michael Kledis of Peridot Consulting. Thank you for joining us. Today we're going to talk about business valuations. Now, what exactly does that mean? From a marketing perspective, it usually means what is the value of your company, but I'm sure there's a more technical term. So go ahead, John Michael, what does it mean?
Business valuations, what it means, it's what is the value of your company.
Oh, so I had it right.
I'm just being, I don't know.
But
crass.
Before we get into that, let's go into some interesting facts. So I actually have an interesting fact or factoid. So you can actually get a certification to do business valuations. Did you know that?
Can you?
And I think that you might have one. What did you have to do to get it?
Oh, well, you have to have relevant experience.
What does that qualify as?
Well, you have to submit cases. You have to submit clients you've worked on, valuation engagements you have done.
So Joe Blow out there that has never... Okay, well, let's say
you can't walk in off the street.
Mari Peterson, a marketing consultant, cannot walk in and say, I'm a certified business valuations consultant.
So
right?
Yes and no. So let's back up a little bit. So there's a few certifications you can get in business valuation. One is the CVA, Certified Business Valuator, or Certified Valuation Analyst, which is what I am. There's the ABV, Accredited Business Valuator. That's with the AICPA. And there's been some others that have come and gone. There was a CBA, which is Certified Business Appraiser. To answer your question, do you have to have a certification to do a business valuation? And the answer is no.
That's kind of scary.
It's very scary, and you'll see nothing wrong with it, but you'll see some highly experienced business brokers that say they do business valuations, but they are just doing what we call rule of thumb calculations or quick things and saying this is the value of your business, which isn't necessarily anything wrong with that.
So
but
what do you get then as a certification? What did you have to learn in the certification process?
Yeah, so to certify, like I said, you have to show that you have the experience. You have to pass a big exam on it, multi-part exam. You have to do a couple case studies. I'm the CVA, Certified Valuation Analyst, with the Association of Certified Valuation Analysts. After you pass the exam and everything, you have to do an actual case study where they give you a mock business valuation, and you have to do that, submit it to them, and they have to make sure, not only are you good at passing a test, but you can actually do a business valuation and show what it, and they grade it and get it back to you. And I did all that, and not only did I have the experience, and you need help. What are you trying to do?
Well, I'm looking at this humongous book that John Michael brought for this podcast, which we're not going to go through that whole book, are we?
I'm going to read it from end to end.
How thick is this book? And what is it?
It is over, hundreds of pages long.
Well, from my estimation, it looks like it's almost 1,000 pages because it looks like a full ream of paper.
Yeah, that's one.
500 pages is in a ream.
Yeah, when I was studying, this is one of 5. I had 5 of these books.
And this is front and back, small itty-bitty font text size.
Yeah, so there's a lot of nuances in business valuations.
You also have to do continuing education, right?
Oh, yeah.
How many hours?
30.
30 hours?
Every 2 years. Oh. And I get them all overlapped a little bit. But 30 hours a year, actually, average to 60. But anyways, I have to do a lot because I have a few certifications. I have to pull out. I have a spreadsheet keeping track of my continuing education. But yeah, so to become a CVA, it's not easy. It's no small task. It's a long process to do it. Not only you have to have the experience before they even let you in the door, but you have to study a lot and pass a test. And then you got to show that, after you do all that, you got to show you can do it.
So why would anybody need a certified business analyst?
Certified valuation analyst?
Yeah.
It can be for anything. I've done just simple, like, hey, I'm thinking about selling my business, and that's sort of the stereotypical. Let's get back on the business broker for a second. They may do what we call napkin math or rule of thumb calculations, which is fine, but it's sort of like the difference between them and me is you might be selling your house for real estate, and the real estate agent might say, oh, it's probably going to be about, we'll probably sell your house for $200,000. But then when the bank comes in and wants to give you a loan on that house, you have to have an appraisal. And that real estate agent's letter is not going to mean anything because it's the appraisal that they loan on. And think of me, now banks don't give loans on business valuations, but think of me as that person that actually knows, that's the accountant that's gone through the certification process, that goes through and actually does a full-fledged valuation. I've got an example valuation report, and the average valuation report when I do my business valuations are 50, 60 pages long. They're not a small thing.
So certified business valuations involve a lot of paper.
It's a lot of paper, a lot of research.
Well, and the reason I say that, I'm not being, like I normally am, quippy about it. What I mean by that is if you have a guy who's doing napkin math for your business valuation, I don't think that holds up very well in a court of law or for banking purposes, whereas a bank is not going to accept napkin math.
Well, and a bank won't necessarily accept a valuation either. But when you're trying to substantiate that, hey, my business is worth $1 million, and all you did is take last year's net income and multiply it by 5, and that's where you got your number. There's not much information. A full valuation report will have economic research. It will have history on the company, past history of transactions in the company, 5 years comparable financial statements, where you normalize those 5 years of comparable financial statements. Normalization is a term in valuations to where you bring those financials, for lack of a better term, back to normal. An example is, say I'm valuing Mari's coffee shop over here, and every year Mari, she owns the building she's in, so she pays herself $6,000 a month for rent, even though the average market rate is $2,000. She goes to Hawaii every year for a coffee convention and spends $10,000 a year going to this coffee convention. All may be legitimate business expenses, not to get into tax realm here, but all may be legitimate expenses for her business. But, when you're trying to normalize it and compare it to the average coffee shop, you got to adjust for that. You got to say, all right, that $10,000 a year Hawaiian trip isn't a normal thing, so we're going to take that out. The $6,000 rent, actually, when you compare it to market, it should be $2,000 a month rent, so you normalize for that. Mari, because she was paying herself and so much in rent, was grossly underpaying her wages, so you got to normalize for that and bring her wages up to par. And within all that, there's research. I get into databases of average compensation per job per area is where I get compensation data. There's all types of research involved in these valuations and databases that you get into. But I don't want to digress too much deep into like what a valuation is or the inside of it, but kind of get back to your original question as to like, why would you want it? And of course, yeah, figuring out the value of your business. That's the easy one. Another one is, your a partner just died and the estate wants to know what was the value of that partnership because, for whatever reason. So you might need an actual valuation that the attorneys are going to hang their hat on. If you did a napkin math valuation on that, it's not going to get you very far. You want a full-fledged valuation for that. If there's in that same thing, there's a partner buying out another partner. If there's a legal issue, a divorce, and the two people are fighting over the value of that business, and one says it's worth $5,000, the other says it's worth $5 million. Who's right? And who gets, how do you split that? So you need to bring in an actual certified business valuator that does a sanitized valuation with full research and everything. So there's many reasons that you might want to do a valuation. A professional valuation, is something that you more or less can hang your hat on. But there's going to be nuances, and within every valuation, you may have two of the best business valuators in the world value the same business, and they both may potentially have completely different values. And it doesn't mean because either one of them are wrong. It just means that they both looked at it with a different perspective.
Well, after the break, I'd like you to tell me what exactly is included in a business valuation.
Okay.
This podcast is brought to you by Peridot Consulting and Marketing Outpost. Peridot Consulting offers a new paradigm in accounting services. We work with individuals and businesses toward prosperity and financial happiness. Please visit www.peridotconsultinginc.com for more information. Marketing Outpost provides strategies to solve problems and strategies to grow your business. Please visit www.marketingoutpost.com for more information.
So now getting back to my question before the break is, you have here, it looks like 50 to 75 pages worth of stuff. I guess it's a business valuation
This is
sample.
It's an actual one I did.
So what is included?
In that 50 or something odd pages? Well, it's all the way from the very beginning as a certification letter that, I valued this company for the purpose I valued it. There's a valuation date. So the key is you got to pick a date. Like, when am I valuing this? Is it on December 31st, whenever? That's a key date. What is the value that we're kind of putting a stamp on this thing? It's saying that I was adherent to my professional standards during this valuation with the National Association of Certified Valuation and Analysts. Then I say, the purpose and the value. So that's a letter at the very beginning stating all that. But the contents of that, my father is an accountant, and he'd always kind of chuckle at valuations because he'd be like, it's 50 pages of stuff, and two pages is really the calculations. It's like, yeah, that's true. But in reality, the calculations are probably 15 pages. But when you get into the calculations, you've got to consider a bunch of stuff, which is the other 40 pages. You've got to consider, what is the history of the company? What is the prior stock transactions of this company? What is the demographics of the area? What is the local economic data? What is the what are their current leasing obligations? What are their employment situations? All types of information that you put into the valuation report. Basically, the valuation report is supposed to have everything there so that nobody has to come ask you a question. So you put the company identification, the nature and history of the company, all that information in there, the key customers, the key suppliers. What is the strategy and the future plans of the company? What is the government and regulatory environment of this company? What is the market share of this company? The current facilities. All these things are key, and that's a lot of research, a lot of looking into. If it's a brand new engagement, it's a lot of time to look into to find these base facts out, because all these play into how you're going to draw these calculations out later. And then with that information, with that research and the general economic outlook, you get into what I was referencing earlier, normalizing the financial statements to where, you start coming through the financials. There's a lot of forensic accounting when it comes to normalization of the financial statements. Why is miscellaneous expenses $20,000 more this year compared to last? And you usually have 5 years of financials, or ideally, you work with what you got in some cases, but ideally you're going to have 5 years of financials. And you got to look at each year side by side, normalize them up and down the rent, up and down the owner's compensation, look for, $20,000 miscellaneous expense. Oh, that was, they bought a a fluffy sign for out front for this fun marketing thing they were doing. But that might be a one-time expense. Or you look at all these other factors and you find out that they weren't paying their, 3 of their staffers because they were paying it through another company. So you got to normalize and make sure that pay is included in this. There's all types of forensic accounting, digging through the financials and normalizing them to the best of your ability so that they represent a true picture of the income and expenses of this company. So after you do those normalization adjustments, you use those numbers to do your financial analysis, your ratio analysis. You summarize that information. That's all in the valuation report. And then that's all even before you get into the valuation itself. That's just all getting to your base information.
Who reads all this stuff?
I read it all the time. The favorite thing in the world is when I get somebody else's business valuation. I love reading other business valuations. But then, let's just talk about actually valuing a business. There's 3 commonly accepted ways to value a business. The asset approach, income approach, and the market approach. In some ways, they're self-explanatory. Some ways, they're not. The asset approach looks at your assets and your liabilities. So if you're a big manufacturing company with millions and millions of dollars of equipment, that's all paid off, and that equipment is still today worth millions and millions of dollars, then you can just kind of look at your assets and say, well, your assets are worth $1 million. That's the asset approach. It's pretty black and white. And then you take off any liabilities. Well, you owe $500,000 on that equipment, so you kind of go for that. Or if you can get an appraisal, that equipment, you bought it for $1 million, but it's actually today only worth $200,000, and you got an appraisal saying that equipment's only worth $200,000. That's all factored into the asset approach. What does your actual balance sheet have on it? And you can up and down that to market value, and that's the asset approach. And then there's liquidation value if you sold it all tomorrow, and there's different methods within that. Then there's the income approach. The income approach takes those normalized financials and through a few plethora of each one of these approaches has methods underneath each one of them. There's not just one income approach. There's like 30 income approaches.
But we're not going to go through that right here.
No, but it's I'll dumb it down. So basically,
wait a minute.
You're taking indicators. You're taking summarize it. You're taking certain indicators of that normalized data, the earnings before income and taxes, and you have what they call capitalization rates and discount rates, which are derived from economic indicators. Those capitalization and discount rates come from like a compilation of long-term growth rates, which are like the 20% yield for a treasury bond, and premium discount rates for like the size or special purpose rates. So you take all these discount rates and you factor those in against like indicators from the normalized financials like earnings before income and taxes, and you multiply it by that discount rate, and that's your value. And you may do that by the 20 or 30 different methods, and you're going to have a range of values, and you can weight those values out accordingly and have they say a value for your income approach and a value for your asset approach. And then the final approach, the market approach, is explanatory best with real estate again, that if the house across the street sold for $200,000, I guess my house is worth $200,000. So with the market approach, there's databases out there from Deal Stats to BizComps that have historical company sales on these databases. You pull those and you look at their indicators. For example, that company sold for $2 million, which was 5 times its gross sales. So then you take your gross sales, multiply it by 5, and that's apples to apples, and that's what your value is worth. But you do that through a few different indicators, and you're going to get like an average market approach. And then you're going to have a value for the asset, a value for the income, and a value for the market approach. There's also other market approaches, guideline, public company. I don't want to get too wonky, but
I know. And as you're talking, do you know what I'm thinking about?
sleep.
No, Shark Tank.
Yeah.
Because I think they always, isn't that the first thing that they open up with whenever it's a new episode of Shark Tank? They go on there and they tell them what their business valuation is so they can tell them how much money that they are asking for. And then they start grilling them about, well, how much debt do you have and how much money are you making per X widget? And they start asking about stuff like that. Isn't that sounds like a combination of both the income and the asset approach?
Yeah. I mean, what they're doing is they're taking, okay, so you got your $1 million value. If I applied it through this approach or this thinking, that's how you got to it. But, there's 3 different ways to get to a value.
But you hear them often on there say, well, how did you get to that kind of valuation?
Yeah, exactly.
And then if they're like, it's really inflated.
Sometimes. Yeah. No, on Shark Tank, sure. I agree. But if you actually get a certified valuation, you're going to have at least one of these approaches thoroughly thought through, and if not all 3. And sometimes it might be easy, like the asset approach just does not apply. If you're a company that has no assets, but you're making $1 million a year because you're a phone hotline and your only asset's a phone, it doesn't mean your company's not worth $1 million. It just means you don't have any assets. So when you're doing a valuation, you wouldn't consider the asset approach for that company. Some companies, it's, you can you can look at them all and consider them all. I do valuations where I'll consider all 3 and you can weight them. Like the asset approach is saying your company's worth $500,000. The income approach is saying it's worth $1 million, and the market approach is saying it's worth $3 million. And you can factor those all in and weight them together and say, if I weight them all together accordingly, your company's worth about $1 million. And I just factored all 3 in. There's different ways to do that, and that's where the nuance I was alluding to earlier, that 2 business valuators can value the same business and have different values. Not only, what approach did they choose and why did they choose it? What discount rates did they choose and why did they choose those? And why did you choose to weight the income approach higher than the market approach? And those are all things that the valuator needs to be able to defend. And part of this report and all these other indicators to say, because of these reasons, because they're in a good economic area, because of the trend line and future plans of this company, I chose to weight the income approach higher because that seems more representative of where this company's at. Now, there's a lot of, argument there. And, the valuator, I would lose my license if I did a valuation based off of a contingent fee. Meaning, hey, I get 10% of the value of your company when I value this. So I'm going to value it at $1 million and I'll get $100,000 fee.
Yeah, that would seem to be not kosher.
No, it's not. It's not. You would lose your license if you have to sign a attestation that I have no stake in the outcome of this. Even if it wasn't in the
so
fee.
You can't own stock in that company too and do a business valuation.
No, I couldn't do that. I couldn't. If I was biased, I have to have an unbiased perspective. Owning stock is a bias. Or if there's a bias that maybe doesn't hold, I'm valuing a company and I also do their tax return. Now that happens, that doesn't keep me from doing a fair value, but I have to disclose that there's a relationship. That, hey, I also do their tax return, but it does.
Maybe you go axe throwing with this guy every week. That doesn't preclude you from doing his valuation.
Yeah, but if I have like a tangible economic benefit on the, this valuation being higher.
What if you serve on a board with him?
Yeah, no, it's just.
Did you have to disclose that?
Potentially. It just depends on the relationship. Probably not, because that's just, if you're going to, at a certain point, standing in line behind somebody doesn't mean you have a bias. But
guess it depends on the angle.
Just like anything, if you think there's potential for bias, disclose it. Period.
Right.
At the, if you're worried about it at all, disclose it. And that's part of it. There's a whole qualifications, about 14 points saying, about this valuation and every valuation we do. So it's a lot of nuance, a lot of, making sure that you're not biased or you're not doing this out of a certain criterion, and that you have basis and an understanding as how you got to your value. But outside of that, it's a lot of interesting work. It's a lot of research, a lot of these database pulls, a lot of financial analysis. And there's a lot that goes into it, as I think I was kind of alluding to. And then you get your conclusion of value, and that's how you do it. And then what I'll do, a lot of industries will have what they call rule of thumb values. I alluded to it before. Some industries, like insurance companies, say, well, your insurance company is worth about 1.5 of your sales. Well, I pull 11 insurance company sales that happened in the last 10 years, and not one of them were 1.5 of the sales, or even close to it. But that's what the industry states per their manuals that their rule of thumb value is. But it does give you a ballpark. So if you're quickly like, gee, I wonder, I'm an insurance company, I wonder, I'm going to do 1.5 of my sales, or give me a ballpark. It may be 20% off, but at least it gives you that range. But another rule of thumb for a brewery might be 5 times of your net income. It's not anything to do with 1.5 of your gross sales. So it's all different rule of thumbs. There's certain standard rule of thumbs, and they're meant to do nothing but to give you that threshold of materiality. But when you actually get into the true valuation, it's going to be 20 to 30% away from that rule of thumb in any direction for any reason.
How long does it take for you to do one of these?
A week-ish. It depends.
Wow. You can pull all that together in a week?
Well, some of them I do in 24 hours, but it's depending on how much head down time I have. But if I have a solid week, I can do it, or less than that. If I have a solid 4 days, I can maybe pull a valuation, but it just depends.
How many hours is that?
Like 10 hours a day, yeah.
Wow.
Plus. But I mean, it depends on how. Now, it could be months if it's a new client I don't know anything about, and I actually got to do site visits and interview them, and there's it could be drawn.
So not all of this is just research and pulling together numbers. Sometimes you've got to go do a site visit and talk to people.
Oh, definitely.
And do you talk to like more than one person, not just the owner of the organization? You're talking to other people? It
just depends on where you're going, how big it is.
Do you go to the accounting office and say, I need to pull this information and these reports?
Yeah, so a lot of what I do this no matter what I do. I don't think other evaluators do, but I do verify the financials. It's like kind of a base forensic accounting. A lot of times people are like, here's our financials, and they are what they are. But I if you took that at face value, then they could just be making it up, right? So I do verification of financials. The way I do that is I compare them to source documents, compare them to the bank statements, compare them to the general ledger. If they have loan statements, I get the loan statements and compare all that and make sure the balance sheet ties to the source documents that are third-party documents. And once I am satisfied that those tie, I can then depend on the financials to move into my normalization phase. And once normalization is research, well, what are you paying for rent here? Well, what I have to reach out to, do some research. A lot of
information you have to gather.
Yeah, it is. What is your lease agreement? That's a big thing. Do you have a lease agreement? What is it?
Well, in a lot of ways, it's, there's a lot of work that goes into pulling together a marketing plan.
Yeah,
it takes me anywhere from 2 to 3 weeks to pull together a really comprehensive marketing plan.
Yeah, it just depends. So, but I mean, if I had all the information sitting on my desk, then I could, the actual just doing it is 2 to 4 days. But it's just
there's
like
a lot of precursor work. Well, it sounds like.
It's just
you don't just go in there and do it in 4 days if you're having to go interview people and site visits and all of that.
Just like anything, it depends on the availability of information. But my 50-page valuation reports. There's software that helps me out with the financial analysis, with the database entry, things like that. I'm just not pulling Excel out and writing a 50-page report. But there's some really good valuation software out there. Yeah. But it's, I'm an accountant, I'm a certified fraud examiner, I'm a tax guy, I'm also a certified valuation analyst. So all those tools help exponentially when I'm getting to the end result of a...
Sounds to me like a very busy brain. Okay, so I think we are wrapping it up.
Yeah, so that's quite short and quick of a business valuation, but just, I think, to illustrate that there's just a lot to it. And it's not just as easy as, well, that guy across the street told me my business was worth $1.5 million. Well, there's a little more to that. And that's all. Well, you want me to take us out, Maury? I guess I'll take us out. So we want to thank you guys for listening today. And please be sure to review this episode. For more information on who we are or this podcast, please visit www.bammit.com. That's BAMM-IT.com. And next podcast, we're going to be talking about real estate. And Maury's writing that down. What does that say?
Residential and commercial.
Residential and commercial real estate. And we're interviewing two accomplished people in the field of both residential and commercial. And it's going to be fun.
Thank you.
Thanks.
The hosts and the guests of this podcast make no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice and is for entertainment purposes. It is not guaranteed that you will find this as entertaining as the hosts find themselves.